Welcome back to Commodity Champions. We are now joined by Paul Bartholomew, who is Senior Managing Editor at S&P Global Platts. Paul, hi. Thank you so much. Let's start with what's been happening in the metal space. It's been quite a week, couple of months, if I can say so, for the metal prices, which have been very volatile, under a lot of pressure. And we have seen nearly 15 to 20% of a decline in last couple of months. Would you give it all to the US-China trade war? And how much impact would you actually see coming even from now in metals?
Yeah, I think the biggest impact of the all the talk around the US-China trade war is that it actually sort of freaks out the market a little bit. It just causes a lot of uncertainty. Buyers hold off a bit from making purchases when they're a bit uncertain about the market direction. And also because China is increasingly a sentiment-driven market where there's a lot of participation in steel and raw materials futures, that has a flow-on effect into the physical markets. But what we've seen previously when the US first announced the Section 232 measures is that the market sort of gets the jitters for a few days. Prices tend to go down, and then after a few days it sort of gets back to normal again. But everything's happening so fast at the moment, with the US talking about putting in sanctions, or not sanctions, but import tariffs rather, on auto, white goods, and all this sort of tit for tat sort of behavior going on. So it's the fact it just causes that sort of uncertainty that can have some downwards pressure on prices.
Well, yes, the global market jitters and the uncertainty have taken the zinc and copper prices to 13-month lows in this week. What's your sense from here on?
The fundamentals are sort of, fairly solid. If you look at China's, housing section, which uses a lot of copper, it's still very, very robust. If you look at fixed asset investment in property, construction, and infrastructure, it's all fairly strong. It's all in growth territory, not quite as strong as last year, but it's still robust. I think downstream demand is still looking fairly healthy for most metals.
So given the kind of moves that we have seen in the metal prices over the last couple of months, which has been 15 to 20% on the weaker side, would you say that all the bad news in the global markets has been factored in, or do you see further slide?
Yeah, well, I mean, the whole, trade war in inverted commas saga is very much is an ongoing topic at the moment. With their announcements from out of the US or China or the EU on an almost daily basis, and there's been huge numbers mentioned, involving billions and billions of dollars worth of imports and exports. So I think while you've got that market uncertainty hanging around, it is going to kind of cause some jitters. So it's going to add to some of the volatility around some metals prices. But if you just sort of take that away and you look at some of the fundamentals in China, which is obviously the biggest consumer of most of these metals, it's still very, very it's very sound. It's very robust. Most of the end user segments, manufacturing, property, infrastructure, they're all still performing fairly strongly. So you'll get some volatility, of course, but I think we're not expecting the prices to sort of drop off a cliff or anything like that, because they're well supported on the demand side in China.
So, Paul, even in a market of uncertainty and jitteriness and a lot of high reactions, as we have seen, what metal would you choose on right now, where you see a stronger fundamentals?
Well, we still see, I guess, steel being a very strong performer. I mean, it hasn't, been subject to some of the. Of course, the price fluctuates, but generally speaking, it's been a very strong performer now. We're almost going into the third year. I mean, the market recovery occurred in 2016. Last year was a very positive year. This year is a very positive year. Like if you talk to Indian steel makers, Chinese steel makers, or European, they're all fairly positive about the state of the steel price. So we'd expect that to be a fairly good performer for the rest of this year.
We hear that. So it really is going to be about the steel prices, which are expected to be the best performers. Well, we have seen steel prices actually at 10-month highs and the hot roll also at a record high during the day today. So 2018 perhaps could be the year of steel when it comes to the metal sector. But let's also get talking about the LNG market, and Mark Hawson is Director of LNG Market Development at S&P Platts. Mark, hi, good to have you. This is a market that clearly has been evolving in last many months and years, if I may say so. Cleaner source of fuel and energy is how it is being treated, and much importantly so. How do you think LNG will play a part, especially for countries that are looking for options other than crude?
Thanks, Manisha. We certainly find it a very exciting time to be in the LNG business, and the reasons for that are both cyclical and structural. On the cyclical side, we are seeing a 50% increase in LNG supply from 2015 levels going out to 2021, and that's primarily underpinned by new projects in the United States and Australia ramping up. That supply growth, of course, is being absorbed, like you say, particularly from the Asian markets, and particularly actually in the first half of this year, Indian LNG imports actually grew by almost 20%, and India is now the world's fourth largest LNG importer. If we think about the structural factors, Manisha, which in a way are even more interesting to us, obviously the cyclical factors move from an oversupply to undersupply situation every 5 to 10 years, but we're seeing big changes in the way LNG is being transacted, particular non-pricing factors with contracts becoming shorter and more destination flexible, but also very much on the pricing side, an increased use of LNG spot pricing in Asia, whether that be based off the Platts JKM, the benchmark LNG spot price, or also the Platts DES West India LNG price. We see increasing adoption of both of those benchmarks, and then of course the trade in LNG derivatives has been very fast growing in the last couple of years as players need to hedge that physical spot LNG price exposure.
Well, the last 5 years have been good, as you said, but Mark, what's your sense as we go forward from here? How much of an expansion, what kind of spend are we looking into this for?
Well, certainly, Manisha, if we look out until 2021, that growth is all underpinned by LNG supply projects that are already under construction. And so certainly until 2021, we will see strong growth. We're about halfway through at the moment, the big ramp up in the production. The next question is post-2021, where is the next tranche of LNG supply going to come from? Because there have been relatively few final investment decisions on new LNG projects in the last couple of years. And bear in mind that projects typically take around 5 years to be constructed. So there's a potential supply shortfall in a few years' time around the 2022-23 timeframe.
Well, that doesn't sound so good. But since you said that India is now the fourth largest importer of LNG, do you see the import scenario, the growth continue in the coming years as well? And, do you see a jack-up in imports? Because whether it's the power sector, the fertilizer sector, the households, LNG really seems to be getting a very strong mix here.
Well, what we can say about India so far, Manisha, is clearly LNG imports were actually relatively flat last year into India. And a lot of that was because the supply projects were a little bit slower to ramp up than we were expecting previously, but also because demand in Northeast Asia was so strong last year. And you rightly highlighted China. China experienced almost a 50% increase in their LNG imports last year. It's now the world's second biggest LNG buyer. That very much pushed up LNG prices and made it that much more tricky for Indian LNG importers to grow their LNG imports last year. Like we touched on before, this year is a different story. Imports are up 20% year on year, and that has just been facilitated by the increased LNG supply this year, as well as slightly lower prices at the moment if we think about where LNG prices were in the winter time. The DES West India price assessed by Platts is currently $9.80 per MMBTU, whereas the Japan-Korea marker is trading at $10.10. So a discount to Indian buyers off the Northeast Asian price when they are looking to attract cargoes.
All right. Mark, just coming back to India yet again. So what is your, what have you worked on? What is the forecast or the trajectory that you have prepared in respect of India in sense of demand, in sense of pricing, and of course, the growth in consumption?
That's clearly a question. I mean, we've been traveling around India a lot this week. That's a question front of mind of buyers and sellers. I think obviously gas currently represents under 70% of the total energy power mix. And the statistic we heard from the chairman at the Platts Delhi conference was that 14 of the world's 15 most polluted cities are actually in India. And I'm sure that's one of the key reasons underpinning the Indian government's drive to increase gas's penetration to 15% of the Indian energy mix by early next decade. Like you say, some of the challenges within India at the moment revolve around gas pricing, but you also highlight infrastructure. At the moment, there are 4 LNG regas terminals operational in India, but they're all on the western coast of India. And quite frankly, the pipeline infrastructure from those terminals to the market is not fully developed at the moment. There are projects underway to release some of those infrastructure bottlenecks, particularly around the Kochi LNG regas terminal and the linkage of that terminal to the nearby markets of Mangalore and also Bangalore, and also the cross-border Indian gas pipeline. At the same time, there's the IOC regas terminal on the east coast of India that should start up soon. So these infrastructure bottlenecks are slowly being eased, and that should underpin the next tranche of Indian LNG import growth.
Well, a lot has happened, but plenty still awaiting to happen. Mark, thank you so much for joining us. And it's an interesting numbers that you have given to us, that the Indian demand, of course, has been running up by 20%, but the Indian gas mix is quite low. And that is something, of course, the policymakers and the oil-producing countries, of course, will have to take a look at. Well, thank you so much for joining us, gentlemen. And with that, it's a wrap up on this edition of Commodity Champions. Thank you for watching.